how to do it correctly, this is the way you do it. There's all kinds of time and opportunity for pyramided trades, but you first have to get good at trading with one micro contract. One micro contract. Because what that does is it removes, hopefully, this is the only thing you can do to fend off the greed and fear. You can't blow the account if you trade with one micro and you only take one trade a day. It's physically impossible for you to go out there on day one and blow the account. But see, that's what your subconscious is fearful of. I don't want to blow the account. I don't want to have a big losing trade. I don't want to go into big drawdown. Okay, that's easy. Don't over leverage your account and don't take more than one trade a day. But ICT nothing. If you want to be able to do it correctly, you have to do things with a process. There has to be a logic behind it. There has to be some measure of rule-based thinking, and then you have to adhere to that. If you don't want to adhere to rules, I promise you, you're going to lose, you're going to fail, and you're going to blame me, you're going to blame everybody else, you're going to blame the prop firm, you're going to blame the brokerage firm, you're going to blame everything but you. I know this because I did the same thing as a 20-year-old. I did the same thing numerous times. I have students that repeat the same thing. They've sent me hate mail years ago. Oh, you didn't teach me right, this, blah, blah, blah. And then later on, they went through it properly, and then they send me emails apologizing. It was a mistake on my part, ICT. I didn't listen. I went back and re-listened to it all, and I made all the mistakes you said I was going to make if I didn't listen and just plunged ahead and did what I wanted to do. Now I did it the right way. I listened to what you were expecting in terms of a properly mindset student that follows the rules and accepts the adversities initially that are normal. They're all normal growing pains. But see, you're trying to be the exception. You don't want it to happen to you. You think it's going to be candy bars and milkshakes and just everything's sweet and lovely and butterflies are going to come land on your hand and everything's kumbaya. No. No, 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 no. As soon as you push the button, you're asking the shark to take a leg off. You're asking that lion to take your face off. You're inviting it. That's what it is. As soon as you enter these markets, you've entered the jungle. You've entered the deep waters. And honey, everybody's hungry. And if you offer it up on a silver platter, they're going to take it and eat it. And you can't be upset about it. That's the currency here. Yours or mine. Mine or yours. That's it. It doesn't matter how anybody else trades. It's, are you liquidity right now? Are you liquidity? Because if you're liquidity, you're lunch. I go in and I'm looking for lunch. I'm looking for the liquidity. I'm looking for reasons why the market will trade to this level, why it could potentially trade to this level, but I don't need it to trade, for instance. This is the draw on liquidity. Draw on liquidity is just a initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean and it does not define the absolute terminus to a price run or the be all end all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely, but it's still an initial idea. So when you're first trying to learn how to read these markets, when you're first trying to determine where the market's likely to go, you have to strip away everything that you're trying to force into reading every single individual candlestick. And if you watch a lot of my videos, or if you have a lot of notes, or you've dabbled in things, chances are you probably already have a pet technique that you want to be yours. And you may not even be good at using it yet, but you just want it because it has a cool name, like a Reaper fair value guy. You know, when I taught that to my private mentorship, they're like, "Oh man, that's gonna be my thing. that's gonna be it for me." You know, or Event Horizon, which is the midpoint between two new week opening gaps or new day opening gaps. And because of the names, okay, these names are meaningful to me. They're not meant to inspire you to want to do them over another. It's just that's what I name them. I got 81 of these things, so it's a way for me to keep track of what its purpose was, and or it kind of puts a little stamp of when I discovered it and something had a impact on me and it was a cool name or inspiration to it. So when we're looking at price, as you as a brand new student not knowing what to do, you want to make this kind of like a game and a discovery, something fun, not a video game, okay, but it's a game of determining, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming. It's okay. I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? So in other words, if you had a shark, if you had two sharks rather, you have two sharks in front of you. One has had its teeth removed. Well, that would be represented something like this. This is the shark with no teeth. It's basically got gums. Okay, there's no teeth there. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness, the jaggedness, the jaggedness, and now it's going to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? So you observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, okay? If you're looking at it through the lens of a second chart, sub 1 minute, or a weekly chart or a monthly chart or a quarterly chart where it's 3 months of data compressed in to make the candlesticks, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. We've already mentioned down here, let me show you. Now, don't be discouraged if you can't watch this stuff real time and see it or outline it in advance. It's okay for you to come home for work and look at your charts after the fact and go back and look at this and study it as if you have obviously the benefit of hindsight initially, but you don't want to stay in that very long. So you're going to have to procure yourself some instruments that will allow you to watch price action, not with market replay. Look, I am not a fan of market replay. I absolutely loathe it. I hate it. I can't stand it, and I wish it wasn't available. I wish it wasn't even available to any one of us, because it's a crutch that allows frauds to be able to sound like they're smart and teach something because it's already happened. If you can do it over live price action, not just once in a while, but continuously, and your audience or viewership can see this, then you have earned the right to have a voice. And then people should have no problem sitting and listening to you lecture and talk about what you think is likely to occur, because you have a sound basis or foundation to what it is that you're talking about. And therefore, because you have a track record of being able to talk about before it happens, it removes the anxiety that is reasonable for everyone to have when they first sit down and listen. But when you, as the student, and you don't have the ability to watch it live because you have a job or you're in university or you sleep, like you have to sleep, right? And your place in the world and your general geographic location may not be conducive for you to trade at 8:30 in the morning New York local time. You may have to trade in the London session. And yes, Virginia, I will be up during the London session doing one of these or two of these lectures in a week or two. Okay, so we're not We're not focusing on one specific time of the day. And I'll come back to that section where I was telling you write down the times of the day in a moment. But when we're looking at it initially, you don't have to see this real time to get a collection of screenshots for your journal. But if you don't do this and journal and screenshot and annotate your chart and study how long price runs took place, how many candles did it take to move there, was there any kind of formation in the price delivery that would have caused you to not trust it unfolding? Now that's going to be very hard for you to do because initially, especially the men, they're always going to say, "No, I would have never second guessed it. It would have been easy for me to hold on to that." And these same people, when they get into a trade, if they ever were to do it in front of you, they don't have any conviction and they're going to hurry up and bail out on the trade. Okay, I got to get out of this. I can't stand the pressure. It's moved 5 handles. But they call 30 handles or 50 handles above or below, and they get out at 5 handles because the pressure of it not doing what they expected to do and in realizing a loss in front of someone, that's a lot more pressure for them. And they don't want to have that. So what's more important, their image or them following a model that they have seen works and have trusted and did the back testing and they have the data behind it? Their image. And that's not someone you should learn from. Okay. I'm just tossing that out there. So what we're looking for always, the first thing that you're looking for, Caleb, is where is the market smooth on the 15, the 5, and the 1 minute chart? Is that complicated? Nope, it's not complicated at all. It's real simple. What does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have 2 swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left that frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade, long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it, and they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter. Listen, folks. It does not matter how many buyers are buying the market to go up there, and how many short sellers. Okay. The proof of it is just look at a depth of market. Look at a ladder. Okay, a dom, not a dome. Okay, I'm so tired of hearing people go. It's not a dome. Do you see an E at the end of that? It's DOM. It's a dom. Okay, depth of market. Look at those orders. There's no imbalances there. There's no imbalances. There's just as many short orders below the market as there is above. But yet the market will still march and march and march and march and go to the beat of the drum that I tell you it does. It reaches to these levels because it's coded to do this. And if you do this for a couple weeks, you're going to see, oh wow, yeah, this feels artificial. It feels like it's designed to do these types of things because it tends to repeat every single day at specific times of the day. It will do this. Now let me go back to the times element. Every day between 8 o'clock in the morning, this is always New York local time, okay? So it's very important you remember that because I have new people coming all the time. And they'll say, I looked at this chart here and you told me, yeah, but you're looking at it in Bangladesh time. Okay. I don't live in Bangladesh. I'm in the East Coast of the United States, and the algorithm is on New York local time. I don't care what anybody else tells you. Okay. That's what it's on. Period. End of story. You can wrestle with it if you want, but that's just the way it is. Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Okay, and we've had the 15-minute on. Let's go down to a 5. Okay, so right away you can see that this high here is relative to that one, and this one here also with that. This one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. It does not mean it's an absolute guaranteed outcome. See, I have students that literally take the time and waste their time in writing me an email. Sometimes they're like novels or novellas. And usually it's like 3 paragraphs of congratulating me and worship and whatever. And I don't like that. And usually when I get that kind of stuff, I immediately just push the email away. I don't want you looking up to me. I don't want you worshiping me. I'm not the greatest of all time. I'm not the GOAT. I'm not none of those things. I'm just a guy that has a whole bunch of information and experience, and I want to share it with you. And I want to see what you do with it. But these individuals will say, I need you to tell me how to make sure that I don't have this wrong. I only want to take this pattern. So how do I avoid taking losing trades with a inversion fair value gap or a mitigation block or the breaker? How do I know if it's a breaker or if it's a shift in market structure? Well, that's easy. You have to have a higher time frame premise and a directional draw where the market's going to go. and if you think it's going to go higher, when you see the market creating a short-term turn, um, well, I'll give you an example right here. We have the relative equal lows here, and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. Look at it like this. That's this range low. And see where the body stopped right there? We wick through it, I'm not denying that, but the damage is always done by the wick. And the range high there. Oops, sorry. That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. But the most sensitivity is going to be seen in that last up close candle. That is not supply and demand. That's not supply and demand zone. Sam Seidman would never, ever, ever refer to what I just said. Never, he would never do that. And he would never consider that anyway because we're cutting through candles. Because we're looking at what an algorithm is doing, not some floor trader ticket runner's perception of something that doesn't really exist. So the turn here at the bodies, that tells you what? It tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here. The inefficiency that's traded to there. We want to see it trade above it and then act as what? Support, which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, and my eyes didn't notice this when I put it up here. You see that little separation? That's a volume imbalance. Go back and listen to the other lectures. You have to include that volume imbalance when you have a fair value gap, whether it be BISI or CIVI. Oh, no, there you go. And you can see the bodies being encapsulated by that. And now the market trades back up into that. The bodies candlesticks are trading inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much kind of like coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. This response right here to what it's just done there, that expectation and response in how price can react to levels like that, that's a nice little scalp right there. I mean, look at it. It moved from 515 to what? 596. That's a good run. You can't get 20 handles out of that on a 15-second chart. You can if you know what you're looking for. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30 because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 right there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. In other words, think of like the World Series of Poker. Okay, if you ever watch that, it's really fascinating to see how the long-term players that always find themselves at the final table. They may not win, but they always find their way at the final table. That's experience and that's skill. Well, you can see those things in price action. They're like fingerprints, okay? You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always. It's always like this, folks. It's never not going to be hidden from you, okay? It's always plain sight. But see, you're so enamored by animal patterns, harmonic patterns, gimmicky named supposed retail indicators. Everybody's got a new indicator. I got one for you that's going to beat all of them. It's the open, high, low, and close, and the clock. How about that? How about that? Catch me outside. How about that? Okay. It's simple. And all of you complain, not all of you, but just the asshats do. Oh, this is complicated. This is convoluted. So and so teaches this so much better. Okay, I don't see so and so doing anything. I don't see so and so doing anything but using market replay and trying to convince himself everything he says after he says it. So we had these relative equal highs swept here. See that? Case study, bullish breaker to there. So how many candles did it take to do that? You screenshot it. How many handles did it run from the low to that relative equal high being taken out? And once it does that, keep the chart active with it on there, but then just make it very, very light. Well, not that light, degree. Make it light. So that way you can still see it, but it doesn't have all of your focus. So that way it allows you to focus on, like, there's a fair value gap here. We traded down into mid gap, which is this wick here. Since price is above it, that makes it a discount array. Consequent encroachment of that trades to it. We want to see it run above this high here. Some of you that are trying to learn how to do this are having a blast with this, because not only am I giving you things to talk about in your own journal of focus, but you're also seeing things unfold over a live chart, and you're watching on your live chart. Okay, so this is not market replay. It's not delayed data. Okay, it's not after the fact talking narrative over a chart. Everything that these asshats leave comments on in my YouTube comment section that you can't see, but I see and getting amused by it. So here's the relative equal highs there too. So now, same thing here. You want to mute that in terms of its importance. And now you want to see, does it have the wherewithal to run aggressively for that 17,820.75? Any of this seem complicated to you? It shouldn't. I already know what you're thinking, and some of you said it out loud. Yeah, it's because you're saying it. When you talk about it, it's so obvious. When you talk about it when it's happening, I can see it when you point it out. I just can't point it out when I'm doing it. Right. You're just learning it. You expect to be able to go out there right now if I turn this live stream off and you're just going to just know how to do it right away because you watched me disclose one or two things in one element in the marketplace. Now you're suddenly going to know how to do it. Nobody can reasonably expect to do that. You're placing too much emphasis on being fast. I got to learn how to do it right now because the market's going to stop working next week, next year. I thought the algorithm was supposed to stop working this year. Whatever. Get out of here. Get out of here. The batteries don't run dead on this, okay? When the markets are dead, then the algorithm won't work anymore, okay? But the point is this. The very, very first thing you're doing as an undeveloped, unrefined trader, someone like my son Caleb, okay? Don't be offended by that, son. It is what it is. I've called you worse things. The idea is that you're looking for the smooth areas where the price is so obviously being defended and being presented and being offered for retail minded trades. See, I don't look at charts. I absolutely don't look at charts and think of what retail pattern here I can use to get in sync with a price run. Look at that beautiful delivery, right to that volume imbalance there, which is inside encapsulated in that SIBI. Went right to the high of that. Now, when you're looking at price, you're looking for the obvious, very, very, very smooth relative equal highs or